the chat box feature in Zoom, and we will share as many of those with KC as our time permits. And in order for you to see the slides which KC will share, please use the speaker view screen format in Zoom, and we will make his full slide deck available to you along with the recording. Finally, at the end of the hour, we will move into an extra overtime Q&A session we're calling KC OT. We hope that many of you will be able to remain with us to ask your questions to KC directly on screen. At this time, I'd like to recognize my friend Kelly Glenn, who serves as the 2020 South Carolina CCIM State Chapter President, and who will introduce today's speaker. Kelly?
Thank you, Charlie, and welcome everyone. So glad everyone could join us here today. It's great to gather the South Carolina and North Carolina CCIM chapters for a discussion with one of my very favorite economists, KC Conway. KC serves as the chief economist for the CCIM Institute and recently joined the ranks of only 9 total individuals to be recognized as an honorary CCIM. KC, congratulations. You always do a great job of explaining the current economic conditions in a way that us commercial real estate experts can truly relate and use your analysis to best represent our clients and business. Your forward-thinking insights have always been of great value, even in uncertain and changing conditions like we're in today. And in addition, you do a great job of adding a little humor in there to always keep us focused and entertained. So thank you very much for taking time out of your busy schedule today to join us. And with that said, I'll go ahead and turn it over to you.
Great. Thank you, Kelly, and thank you, Charlie. It's always a pleasure to speak to the North Carolina and South Carolina chapters. I see Eddie Blanton's on the screen, our president. So glad we kept you from zooming off too far away, Eddie. And notice a lot of other friendly faces, a lot of former colleagues from Colliers, David Lockwood, David Fields. So appreciate everybody joining. So I'm going to share my screen, and we will put these slides up. There we go. All right, here we go. That's what I used to look like. And I don't know what that thing was that I used to wear, you know, in between my coat and whatnot. I think we're going to make them all into face masks, all those neckties or whatnot. But I will tell you, Kelly, I have noticed one thing in all my Zoom meetings, that the professional commercial real estate women all still dress up very nice, even for Zoom meetings. And it's us males that are getting too casual in our whatnot. So I found my coat and all, but all my neckties are being made into face masks right now. So there's my links there if we need anything afterward.
You're just donating that way. So doing a good deed.
So for whatever reason, there we go, so slow. So there's my disclaimer to protect all of you, Kelly and Charlie, and the overall CCIM Institute. All right, so the North Carolina chapter had this great quote. I think it's even better than look up and forward and engage in what if thinking back on May 14th that I just absolutely loved. Life is like a camera. Focus on what's important, capture the good times, develop from the negatives, and if things don't work out, take another shot. So I reinterpreted that a little bit. So on the focus part, let's go beyond the headlines. And we're going to do a lot of that today, and particularly on Thursday, where Eddie and I are going to go over all of the Q1 earnings in less than an hour. 500 companies in less than an hour. I can tell you everything you need to know. Capture the good times. That's look up and forward. You know, don't worry about the dark days deep in the cave. Let's find the light at the end of the tunnel. Develop from the negatives. That's where you're able to do that when you engage in what if thinking. How do you get out of there? And the last one, if things don't work out, take another shot. Be adaptive, and think of it as not only adaptive reuse in commercial property type, but think of adaptive reuse in terms of your skill set. You may not be doing as many transactions, but I can assure you the skill set that all of you have as CCIMs translate into many other tools and things that you can do to make a living during this time frame. So a couple of weeks ago, I did a webinar for the Region 2 on the West Coast, so all the way from Hawaii to Las Vegas and California and down to New Mexico. And so we had fun with the theme. We remembered back, I'm going to date myself. Those of us that are baby boomers remember mom and dad piling us into a phony wood paneled, station wagon, whether it was the Ford Country Squire or the Buick or other, version. And you can see how the kids were put in the back seats there facing sideways. That's why we got car sick. We were looking out the window sideways. The cars drove down the road. And the other reason was if we asked too many questions like, are we there yet? Mom and dad would roll down the window in the tailgate and would suck in all the carbon monoxide fumes and help us go to sleep. if that didn't work, they gave us car bingo. So some of you may remember car bingo. So we'll have a little bit of fun with that, but I enjoyed doing it for Region 2. So I thought I'd start with, as the official start of summer has begun, and we have states, all 50 states are reopening to some degree, to look at where we are, because from a public health standpoint, we haven't won the battle here at all yet. So when we ask why we're reopening, we need to understand that we're really balancing public health risks against economic kind of carnage risks. So this was of yesterday. We had over 5.4 million cases globally. In the United States, we like to win at everything. So we got more than anybody else by about threefold, over 1.6 million cases. You can see the next closest to us is Brazil. It's coming up our way. Then you got Russia, the United Kingdom, and Spain. Where's China? They just, it's kind of like a lot of their economic numbers. They don't exactly get them. They don't exactly get them right. Anyway, you can see then who follows. But let's look at the state rankings. The 5 worst. We know New York and New Jersey, and then Illinois. So it's amazing that our CCIM leadership in Chicago have not missed a beat and kept on going, even though they're 3rd worst in the country. California is bad. Texas is number 7, but they're fully open and going crazy. If you've seen any of the photography and news stories over the weekend. Florida, number 9, Georgia, 11, and Virginia, 13. So I did those so you know what's north, south, and west of you guys. So where's the Carolinas? North Carolina ranks number 8 with only 25,000 cases, and South Carolina number 30 with only 10,000. Although I will, Kelly, and we were chatting beforehand, I think all of those New York tag license plates down in your part of the world over the long weekend, they may be bringing this down your way. What we want to see for the nation is what I've got underneath there, Hawaii. So they've already apexed and they've basically gone down to near 0 cases. That's what we want to see for everybody, but I don't think we're going to see that not only here in the next few months, but probably the balance of this year until we probably get a vaccine. But Hawaii is where we want to go, and you can see where we rank. So obviously we have not conquered COVID-19. So in response to that, I think it's interesting to look at what's happening from our central banks, not only here in North America, but around the world. So I've circled in red there all the North American and both monetary policies, things like rate cuts, and then other policies intervening on the behalf of borrowers and debt holders. So things like state loans or credit guarantees, buying ETFs. So if you notice in North America, we've used every single tool. We've cut rates to near 0. We've thrown everything we can, and the Fed's run up a balance sheet now of over $7 trillion. So notice I've got there and circled in the policy rate cuts. Why weren't there any rate cuts in the EU? The answer is they already were 0 or negative. There wasn't much more you could cut. And so the reason I point this out is North America and the United States are better positioned to recover first among our global partners because we have the biggest, baddest ATM central bank machine in the world, and they've thrown everything at it to try to stand this thing back up. And that's very important to understand in terms of why we're reopening and maybe some of the earnings that might cause you to scratch your heads that we'll cover on Thursday with Eddie. So this is an important piece of it. So I want to emphasize the Fed intervention in COVID because this is the unintended consequence thing that we got to think about 2-3 years out. So even though we just want to get rid of it, hold on, someone wants to get in here. Even though we just want to get beyond it, it's important to look at the Fed's balance sheet. So through May, the updated numbers was $7 trillion on the Fed's balance sheet. At the beginning of this year, the Fed had worked its balance sheet back below $4 trillion. And we freaked out when the Fed took the balance sheet to $4.5 trillion during the financial crisis, all the way up until 2015 when we started to reverse that. So I want you to realize what the items are on the right side there. So you can see securities, particularly Treasury securities. So even though the Fed's in there buying them like mad, and last week we issued, for the first time since the Clinton administration, 20-year Treasury bonds. And that bond auctions actually went very, very well. So you can see 2.7 trillion more in treasuries the Fed has put on its balance sheet. And you can see some other things like notes and bonds, particularly the municipal type, and then mortgage-backed securities. This is Freddie and Fannie. almost a third of $1 trillion that we've added to the balance sheet. If you follow it all the way down, literally in 60 days, the Fed's added over 3.1, almost $3.2 trillion to take our balance sheet up to 7 trillion. So this is what worries me. If you remember back at the end of 2018, when the Fed tried to do its 4th rate hike and really get rid of QE and raise rates and normalize everything, we had a tantrum and we had to reverse it out all through 2019. And you imagine if we had that much trouble with 4.5 trillion and getting interest rates back to 3%, what kind of trouble and difficulty we're going to have unwinding. 7 trillion is probably headed to 12 trillion by the end of the year, first of next year, and going from 0% interest rates. This is going to be a very difficult thing to unwind. And what worries me is this next slide. A little lag here. Let's see. Just a little lag, Kelly. It's not advancing. Let's see if it'll go. I don't know if you can advance it, Kelly, or Paige. It's locked up on me here. Oh, there we go. All right. So it's important that we understand how this crisis and intervention is very different from the savings and loan in the Great Recession. The Great Recession in 2009 was a liquidity crisis. Nobody trusted that they could trade with any other bank. There was no debt exchange. And so all that prevailed was equity. And so rates were largely ineffective. And it took a different type of financial engineering, which was largely a top-down approach, put a lot of money in the banks and hope it trickled down, and that didn't work out so well. We still had foreclosures and a housing crisis. In the S&L crisis, this was really much more complex than S&L's. It started with an inflation problem that then got exacerbated when the S&L industry got deregulated. We then had an oil prices crash, kind of like what we've had right now. Then we had this massive tax law change in '86 that really was the straw that broke the camel's back for the S&Ls. And then we had a massive regulatory oversight failure by the Federal Home Loan Bank Board. We really don't have those elements here right now, at least not in aggregate here at all. So we don't have the deregulation. We don't have a massive tax law change. We had a good one in 2017. We don't have massive regulatory intervention. We don't have overbuilt housing and crazy mortgages. So it's very different this time. So here's what worries me about the intervention we have this time and the Fed's $7 trillion balance sheet and where we're going is we are a fiat currency along with all 184 other currencies in the world. Fiat is a currency that has nothing backing it a value. We're not on the gold standard. We don't have anything but our full faith and trust behind our dollar. And fiat currencies do fail when you print money. And the Fed is printing money, massive amounts of money. Remember, the Fed doesn't manufacture or produce anything, and it doesn't sell anything, so it has reserves to then go buy assets. It calls Treasury and says print money, and then it goes buy assets. Well, the last fiat currency of any note to change or to collapse was Germany after World War I. In 1919, the exchange of the German mark, dollar to the German mark, was 12 marks to the dollar. A mere 4 years later, it was 4.2 trillion marks to the dollar, and the thing collapsed. They do happen. We need to pay attention, all of us as central banks around the world, and us, since we're the biggest, baddest one printing the most amount of money, that this could be something that faces us 2, 3, 4 years down the road that results in inflation. And remember, we get inflation from two sources. The first is commodity prices and asset prices, which are contracting and deflating right now. The other is the value of your currency. And when the exchange partners that you work with don't believe your currency has any value, prices go way up. And that's what scares me, is we have not seen that type of currency inflation in the United States. We've seen it in Latin American debt crises in Brazil and Argentina, but never before here. So this is the unintended consequence thing we need to be thinking about 2, 3 years down the road. So I set up, we haven't fixed COVID. We haven't solved it. We don't have a vaccine. We don't have enough testing. So why in the world are we opening up? We have lots of money being thrown at the problem. So shouldn't we all be able to stay at home? And the answer is actually no. I call this the May jobs report for April period, the Humpty Dumpty jobs report. Jobs had a great fall, and now all the Fedsmen and CEOs have to put Humpty Dumpty back together. I want to point out two things here, the yellow arrows on the left. Our real unemployment rate is 22.4%. That's the U6 rate in the BLS jobs report. The U3 is what gets the headline, around 14%. The U6 is the total that includes everybody. It was actually introduced during the Clinton administration to count everybody, to prove to former Fed Chair Greenspan that we really weren't going to have wage inflation. The other thing is down there, look at the unemployment. We knew it was a big hit in leisure and hospitality and retail, over 7.7 million. And think of this, 47% in leisure and hospitality lost their jobs in April. That's just mind-boggling. Retail trade, though, and professional business services, look at professional business services, 2.1 million. So just because we can work at home and know how to use Zoom doesn't make us immune or able to escape the COVID crisis. So you know that I'm in the camp of a W-shaped recession from my conversation with Eddie back in April at the mid-year governance meetings. I'm really hoping we don't get to a U, which is an extended recession. I think that we're going to have a double dip here. We'll recover over the summer, and then I think we slip back in the fall to the winter when we realize all the holes that we didn't plug. So here's the other reason that we're opening up. The states are out of money in terms of their unemployment insurance trust funds pretty much by July. So this was a piece, this is a map that looks by the Tax Foundation that looks at who's in the best and worst shape. And you know, back in the February when I spoke with you, I boasted about how good the fiscal health was in the Carolinas, and it's a good thing because you're burning through it right now. But this chart here shows the states that are in the best and worst shape. And so California, this was a snapshot taken basically the first week of April 4th. And what you see is California was down to 4 weeks of unemployment benefits. They're done now. They're gone. They're out of money. Look at Florida. So Florida claimed it had 90 weeks. So as you know, when I see something that's phony, I call it barbecue sauce. It doesn't matter if it's North Carolina, South Carolina, or Memphis barbecue sauce. It's just barbecue sauce. Polite way of saying BS. Florida doesn't know how to process unemployment claims. It's having a massive problem. Screwed up software system that they bought. And so we don't really know what the numbers are in Florida. So California's down to 0. Georgia's down to about 4 weeks. One of the things to keep in mind about these numbers affecting states is that when the CARES bill was passed back 60 days ago, that it was the first time that we had allowed 1099 workers and sole proprietors to file for unemployment claim benefits. And so it was a massive increase. So when we compare these unemployment numbers and the unemployment benefits, we are not comparing apples to apples going back in time. It's much, much more. You pretty much need to divide these numbers in this chart by 2 and then subtract another 6 to 7 weeks off them. So in the Carolinas, you would have had 29 weeks, according to this chart, the first week of April. You're now down to something like less than 10 weeks. In South Carolina, you're down to something like less than 8 weeks. So what happens to states when they run out of unemployment insurance benefits? They have to borrow from the federal government. They had to do this during the 2009 financial crisis to a tune that took over 5 years for most states to pay back. That's why these funds and these trusts aren't any deeper or more funded than they are. So the states are out of money. You have massive amounts of unemployment. You got to get the economy back to work. So this was a piece I wrote on Are We There Yet? A couple of weeks ago, in looking at where we are in the stages of recovery. And just as we did not know, nor did we get policy reaction and government intervention right after the collapse of Lehman in September 2008, it almost took 2 years to fully understand it and to fully take action, to fully lower interest rates, to fully create things like TALF and TARP and all those programs. We're not going to get it right here. We're 1 quarter into this, and this is going to take a lot longer. We've never done a massive shelter in place in all 50 states yet across the globe. So this response is going to take much longer than we intend. So what I do is I look at this thing called car bingo, and I'm looking at how do I get bingo, economic bingo on my car sheet to know that we're there. And so I'm going to give you what my indicators are on my bingo sheet. And as you all know, those that can remember playing bingo, that if you can start off and get that center slot, you've got the highest chance that you're going to win the game because you got more avenues that you can go and win on bingo. So I'm going to tell you what that center slot is. So in the upper left corner, you all know I'm a big fan of the transportation metrics. You guys are an important transportation and logistics geography. In South Carolina, you've got one of the top 5 ports in the United States, at least on the East Coast. You got a great port director, Jim Newsom. It's been the fastest growing port in North America for the past 10 years. It's been a big economic development engine that's moved inland to the state. You created inland ports in Greer, and then on up I-95 in the south of the border. Here's a good piece at the top, good news that we want to look for. I mentioned to you a few weeks ago that looking at the TSA passenger count is going to be the best overall indicator of how we're doing and whether we're coming out of this with any speed. So here's the good news. It had fallen from 2.3 million passengers a day flying through our airports up through the first week of March to a bottom of only 87,000 average in the month of April. Here's the good news. In just the last 2 weeks with states starting to open, we've climbed all the way back up almost into the 350,000 passengers a day. That's a long way from 2.3 million, but it's also a long way and a big improvement from 87,000. So you got a 3 to 4 time multiple increase. That's good news. On the lower left, small businesses. 60%, 65% of our economy runs off small business. So if we don't pay attention and understand small business, we don't understand what's happening in our commercial real estate and our economy. So I'm a big proponent of looking at the National Federation of Independent Business data. The numbers are horrific. It was the biggest single month decline in the month of April that they've ever had. Every metric was negative except for one, and that was increasing inventories. That's not a good sign unless you're in the early third quarter building up inventories for the Christmas holidays. I've also mentioned the National Center for Middle Market Companies, which are kind of the middle-sized small business companies. That's housed at Ohio State. And then the National Restaurant Association. They're already showing that 80% of all of our restaurants have laid off anywhere from all to 80% of their employees. Their numbers right now are showing that 25 to 30% of all restaurants do not survive and come back. They're already closed. So these are really important numbers we pay attention to. Up in the upper right, here's a couple I'm going to give you on the right side that are new. So I'm going to work with the University of Alabama. We're an important college town. You guys have several very good and important college towns in the Carolinas. College of Charleston there in Charleston, and you've got these little schools called Duke and UNC and NC State in North Carolina. I think there's another one, the Gamecocks or something, I guess, in South Carolina. David Lockwood and David Field from Colliers will kill me, but they play football in Clemson, another important school. So one of the things I just picked up on was the applications for financial student aid, the FAFSA, the free application for financial student aid. And what they're finding is it's the first time that they've had fewer students apply, that students and their parents have basically said, doesn't matter how much aid we get, you can't afford to go to college this fall. You're gonna have to put it off a year. So that's not a good indicator if you're a college town. We have 136 college towns that play NCAA football. So when you think of 360 MSAs in the country, and a third or more of those are college towns that play football, and the big enrollment declines, that's not a good sign. So I would really look at that. They could see that we're 3% behind last year, over 55,000 fewer applications. That's a really important bellwether if you're looking at real estate or dealing with a client that has commercial real estate in college towns. The other one that scares the dickens out of me is in the lower right there. The Mortgage Bankers Association has just reported that 8% of all home loans are in a forbearance program. That's an all-time record. Historically, we never see that number get anywhere closer above 1%. Going into this year from March, we were down to just 1/4 of 1%. And so this is a very scary metric to be looking at. And then when you look at the percentage of loans that are in delinquency right now when we have forbearance programs, it's not a good one. So these are kind of those metrics that I'm looking around that centerpiece. So what's the centerpiece? It's commercial real estate transaction activity. And Eddie, we shared this with you all at the global mid-year meetings in April. In the upper left corner, this is what we saw. We saw a big decline in CRE transactions in Asia, and then starting in Europe, but not so much in the US. Now fast forward a month and look at the lower right corner. This has just been updated by Real Capital Analytics, and we're starting to see the CRE transaction activity look pretty severe. In fact, Jim Costello just had a new report out this morning, and it showed about a 71% decline among all property types in commercial real estate transaction activity. So despite the Fed's efforts to throw a lot of money and buy assets, we're really starting to see that lockup. I'm going to explain why I think that lockup is occurring. I wrote this piece about a week ago on how do you value commercial real estate during a period of material change. So material change is a specific term in the bank regulatory world that triggers reappraisals and capital requirements. It's really important, and they define it. And what I found was a couple of things. In the lower left corner, many of us may remember, and I don't know if Gary Ralston or some of the instructors are on the line, but many of you, Eddie, may remember back in the oil patch days in the 80s, when we saw markets that went down and looked really awful for a long period of time. We didn't believe that would stay there in perpetuity. When I was in equitable real estate, I had to handle the Colorado and Texas markets during the oil patch. And there was no demand for an office building, and homes, they couldn't even show people up to bid for tax liens, $10,000 on a $500,000 condo in the ski resorts or a home in Denver. There just was no demand. So we said, well, let's assume the market stays that way for a period of time, 2 years, whatever our best educated guess, but then let's model a correction in the DCF and look at where the value came. And what we saw was the value didn't go to zero. It went maybe to something like declined 40, 50 or so %. So one of the skills that CCIMs have, really good DCF and cash modeling skills, where you can help clients and you can help lenders basically look at something like a market correction factor here. And this one should be much shorter and quicker, given what we saw, let's say, in oil patch or SNL type days. The other one that's causing this big decline in transaction activity that we need to understand is PREA came out with a report a week ago, the Pension Real Estate Association. These are all the big pension funds. And the 500 largest of them said they're going to the sidelines. 70% of them said we're going to the sidelines in terms of new transactions, because we have this big event coming up the end of June, and it's called mark-to-market accounting. Requires us to mark all of our commercial real estate assets to market. And after first quarter, there wasn't much economic data out to know how to adjust these or what the full impact would be. So they didn't do much mark to market, but they can't ignore it now when you look at these metrics. When you look at the biggest decline in April retail sales, over 16%, negative GDP, 8% of all mortgages in some sort of forbearance, and over 22% unemployment. So they've got to figure out the valuations, mark their assets to market, and then reallocate allocations. One of those reallocations may be they may mark down to very low numbers hotel and retail, but they reallocate money to industrial and multifamily or other property types. This is what's putting $2.5 trillion of normal CRE activity on the sidelines. So it's not a lack of demand. It's a big accounting and mark-to-market issue that has to occur for one of the largest sources of capital in our commercial real estate industry. And once we get past that in June, here's why I think that PREA and these institutional investors will be back. Where will they find yield? You're not going to find it in treasury bonds yielding something less than 70 basis points. When the Feds told us they're going to be on the sidelines at 0% interest rates, not for this quarter or next quarter, but maybe all through next year even, there's no yield in bonds. Look at the stock market. What have most companies done? Not only have they suspended stock buybacks, but they've suspended dividends. So where do you find a yield in a stock? And the answer is, when we're still going to find 5 and 6 and 7, and you find out with hotel 8, 9, 10% cash on cash yields, I think the money will come back. Understanding that and understanding how to help clients figure this stuff out through things like market correction factors is very important. Another one to understand is what's happening on our debt side. And so on our debt side, someone like TREP in their CMBS data, they're going to have a new report coming out here next week, probably the end of this week, maybe next Monday. It's going to update all the delinquency data on commercial property types, the permanent stuff. And what they found in the last numbers for April was the numbers didn't look so bad, although they were starting to tick up, particularly look at lodging, going from 1.5% delinquent to almost 3. Look at retail, heading back to 4. They cautioned that before loans go delinquent, they go into a grace period and a beyond grace period, and then they get delinquent. And TREP was really good about calling this out, saying these numbers don't reflect what's ahead. And their numbers that they're looking at are things like 5 to 10% delinquencies, probably by July, August, September, fall this year. So the debt side is going to get really challenged. And I don't think we're going to see the kind of workouts that we saw following the 2009 financial crisis with foreclosures. I think what we're already seeing is entities coming in, equity buying the debt, and they're not going to go through the foreclosure process. So one of the skills for CCIMs is going to be helping entities that want to buy the debt from banks particularly because under some of these new Fed programs, you can buy debt from a bank discounted. And if it doesn't work out, you can put it to the Fed in this Main Street facility within 1 year of purchase with no loss. So you get a year to tinker with the asset or the debt facility to see where we go. So I think we're going to see more restructuring and purchase of debt and working it through than we are foreclosure and then work out of the properties. Remember, this is the piece that Eddie and I shared with you, and I've shared a couple of times, is as we go through all of this, this is the thing that we should keep laminated or stuck on a yellow stickum, a giant yellow stickum in our bathroom mirror. And it's thinking about where do CRE values go? Our clients need to know it. Our own investments need to know it. And this graph, this is what I spent a lot of time doing at the New York Fed in 2009 and 10, after the collapse of Lehman and then AIG's intervention. And what the Fed chair then, Bernanke, wanted to know is, where does CRE follow housing in this crisis? And how far can it go? Well, the answer turned out to be in that lower right corner. Commercial real estate asset prices dropped over 40%. And it did it from a combination of cap rates and declining NOI. But in the 2009 financial crisis, it was cap rates that immediately moved. We went in 2008 from 6% cap rates within about 6 quarters to over 8%. That wiped out 25% of the value, just moving cap rates 200 basis points. It was then over the ensuing 2, 3, 4 years that we saw the impact on vacancy, lack of absorption, declining rents that took out another 20%. My theory is that this time we don't see the rise in cap rates, or it's very nominal. And the reason is, with the amount of liquidity infused by the Fed, 0% interest rates out of the chute, commitment to keep them there for as long as they can, and the Fed willing to buy anything and put on its balance sheet, there's no pressure on cap rates to go up. The decline is going to be on NOI. What's the repricing model when restaurants can only have patrons come back in at 50 to 70% the density they did before? They're not going to have the same revenue. They can't pay the same rent. So that all has to reprice. And if we use the same cap rate, it still reflects a pretty big 20, 25% decline in value. The same with hotel. What's a hotel worth if going forward, the average daily occupancy is only going to be maybe 50 to 60%? And not 70+% after that. So we're going to be repricing all this real estate, and this requires a lot of market knowledge and local market information. Again, this is where the CCIM's market knowledge and market courses and training is really going to come into play. So this is what we have to figure out. I'm thinking that we see an average of 20 to 25% decline, less in assets like workforce, multifamily, and industrial, and a lot more in things like hotel. Hotel, it could be 50 to 70% decline. In industrial, it might only be 5 to 15%. So we're going to make all this real clear on Thursday, right, Eddie? He's nodding his head. So Eddie and I are going to do a thing on looking at the corporate earnings reports and what we can learn from them this first quarter about its impact on real estate. If you haven't signed up, it's noon to 1 Central Time on Thursday, and I promise you it will be another drink from the fire hose. It's complimentary to the CCI Institute, so please sign up. And we'll look at a few things. These are a couple I'll just put to tease you that some of you have heard me talk about. Prologis gave us great insights on logistics. They talked about what they saw in lease up and new leasing, rent relief requests. And then Pulte had a kind of a scary view on housing. They were the first public builder to report, but it was followed by Horton, which had a much different take. But they told us things about what they're doing with land, where their traffic is coming from, whether the suburban, flight from the urban areas to the suburban areas is actually playing out. So we'll go over some of that. So here's another one that's pretty important to look at that's positive. And this is looking at auto plant manufacturing. So South Carolina cares a lot about it like we do in Alabama. They have a number of plants. Michigan has the most. And what we're seeing is basically by today or Wednesday of this week, all of the major automobile plants in the United States will be reopened. Here's the bad news. They're not opening at a full 3 shifts a day. They're opening at single shifts with a lot less production, and they're waiting on what? Auto demand and sales activity. So I look at earnings like from Mike Jackson with AutoNation, the largest auto dealer in the country. And he told us that in April, sales dropped by 50% in the first 2 weeks and another 25% after that. When you have 22% unemployment, 40 million jobless claims in the last 8 weeks, I am betting that you're going to see suppressed demand on auto sales. It's going to take us some time to rebuild. But the good news is we've opened all our plants. The bad news is it's only at 1/3 capacity, and we got to wait to see what happens with auto sales to move it forward. Here's the some transportation metrics I look at. I shared with you earlier. This is a big blow up of the TSA passenger count. The good news, you can see that over the the last week going into the Memorial Day weekend, we got right up to 350,000 flyers a day going through our airports. So long ways to go, but a whole lot better than less than 100,000. The Cass Freight Index on the right, we can see that it has fallen to the levels that it was in 2009. This is what happens when you lock up global trade. Ships not coming with containers from China to our LA Long Beach ports, when our plants are closed, when there's no auto shipments, all of those things lock it up. This should begin to improve. We've got to restock a lot in America, and not just our grocery stores and toilet paper. So I watch this very closely. As you also know, I also watch the rail time indicators and what's happening. The rail traffic indicators, both in March and April, set new record lows since they've been keeping data since 1989. But a big part of it was energy and autos. So if we're not putting autos on and we're not moving energy and we're putting it on storage tankers and putting 150 million barrels of oil off the coast of California in storage tankers, that's not so good. But in the March one, I want you to look in the lower right corner. They talked about two concepts that are going to drive industrial warehouse, and particularly important to you in the Carolinas, because not only do you have a great port in Charleston, in Charlotte, you have the only, as you know, the only airport in North America that has intermodal right into the airport between the runways. And it was demand shock and supply stock. So demand shock is all those businesses that are going out. 1 in 4 small businesses have already gone out of business. They just haven't been collected by the state or counted by the state yet to report up to the BLS. Something like 40% of all restaurants are already closed and not coming back. So when all this stuff, this merchandise has been ordered, comes into the ports, gets on the rail, gets on trucks, and shows up at the business and there's nobody there, what do we do with it? We got to store it somewhere. So we're going to have to figure out where we store all this additional demand stock. And the numbers are, it's something like 50 million square feet of warehouse space that's going to be needed. And are we going to put it in our throughput e-commerce warehouses? Probably not. So adaptive reuse of closed department stores, closed retail, maybe inexpensive throwaway building assets nearby in secondary cities could become the experiment for then where do we put supply stock. So again, like demand shock inventory, supply stock is we're going to throw away the just-in-time inventory model from the 1980s given to us by Japan that I studied in business school. And we're going to have additional supply stock. We're going to have extra toilet paper, extra PPE, extra ventilators. We have extra everything. Where do we put it? Well, it doesn't need to be moved and processed a lot. It's an added expense, so we're going to put it in reusable, very inexpensive space. And I think demand shock inventory is going to lead us to where we put supply stock. I'll give you one clue. There was a great piece, I think Karen Minkowski found it, one of your CCIMs in the Carolinas in Charlotte, found it and sent it to me, where it was an interview with Amazon and a developer that had worked, a broker that had worked with Amazon in purchasing over 24 malls that they're just using for fulfillment. Amazon was early to buy some of the Toys R Us stores and use them for last mile. They're already in negotiations to bid for the JCPenney closing stores as inventory. And I'm on a board for a company called Monmouth, where we did one 3 years ago outside of Dallas, Texas in Mesquite. We took an 800,000 square foot mall and we converted it to a e-commerce fulfillment and returns facility for FedEx. So those are interesting concepts that could lead us to great adaptive reuse opportunities. Let's look a minute at housing because it's so important to our economy. Everybody was kind of in denial on housing, January, February, March. I was critical of a lot of the folks putting pieces out saying, hey, Q1 was still up, home prices are still up, sales were still up. And I said, boy, get the metrics, get the forward-looking metrics down first. So I compliment Realtor.com. They started 2 weeks ago with a weekly housing trends view by Danielle Hell. I really encourage you to look at this weekly report. They have pivoted to looking at the forward-looking metrics like listings and delistings and days on the month, days on the market. And you can see all of those metrics are deteriorating. If it takes longer to sell a home and people are pulling homes off the market and they're delisting them because they're in a forbearance program or they're delinquent in their mortgage, what that tells me is things aren't going to be so good with housing going forward. This morning's new home sales, the headline was, it was a barn burner, and was really good numbers. And the reason it was good is they revised all the numbers down from March. The original numbers were supposed to be over 700,000. They revised them down to 619. So the 623,000 existing home sales beat looked like great news. It was better than the expectations of 400,000, but it was nowhere near what the original number was forecast to be. So look at these forward-looking metrics. This Realtor.com weekly housing view report by Danielle Hale is excellent, and I would encourage you to look at it. The other one is this one that concerns me, is rising mortgage delinquency rates. When you have the full loan forbearance option, why are we seeing mortgage delinquencies rise so much? So 3.6 million homeowners are delinquent in April. That was a $1.6 million increase from March. It's the largest one-month surge on record, and it brings the total even to the most since January of 2015. The national delinquency rate now, it doubled from 3% to 6.5%. So think about this. 8% are in a forbearance program and 6.5% are delinquent in their mortgage. We're talking almost 15% of homeowners not able to pay their mortgage or delinquent in those. And that's a very concerning trend. So at the bottom, I gave you who's worse. Mississippi at 12%, 11.9. They have a lot of manufacturing, they have a lot of agricultural, they have a lot of supply chain in terms of agriculture, so it's very hard hit. And that's followed by New York, almost 10%. We obviously understand the situation with New York. New Jersey's right behind it at over 9. So where's North and South Carolina? Well, compared to them, you're doing pretty good, but it's rising. In North Carolina, your delinquency number's up over 2.5% to 2.6 from 2.3 at year end. In South Carolina, yours is up to 3% from 2.7. So even though you have a lot of things going, you have a more diverse economy, you're not as affected as New York, New Jersey, or Mississippi. It's something to watch even in your backyard. So I'm gonna go through a few things on the property type that I've been trying to pull together and to put into perspective. So the first thing over on the left is, how does forbearance play out? And if tenants move and buy without, let's say on the residential, they buy without the landlord's knowledge, while they still have savings, jobs, and credit score, what does that tell us about multifamily? This is what's playing out. This is what the public home builders were telling us in their earnings, like D.R. Horton. They're telling us that all these young professionals are coming out of dense urban areas to the suburbs while they still have a job, they still have credit, they still have savings, and even though they're still on the hook with a rent lease, they're going ahead and buying a house, not telling the landlord, and probably going to walk on that rent. That's a big important item. The next thing is, this was a really neat graphic by the National Apartment Association. Any of you that have multifamily properties or clients, I think it's a good visual because it asks the question, where does a dollar of rent go? And it's going to shrink in terms of who it last goes to, and that's the property owner. So it first goes to the lender. So if now the lender and the borrower have gone into a forbearance program and you tack 6 months to a year of deferred mortgage payments onto the end, you have a higher loan to value and you have more debt service going to the landlord. If you now have higher janitorial and cleaning and tenant turnover costs in apartments, that expense ratio is going to go from the low to mid 30s to the high 30s or 40%. More expenses, more debt service coverage, it means less for the landlord. So I think we're going to see again that repricing, less NOI. Cap rate doesn't change, but less NOI means maybe the property is worth less. Maybe it's only 10% less and not 20 or 25%. The other one I think we need to watch for is this debate and bifurcation between workforce and student housing multifamily. I think workforce multifamily, where people that work live, is going to do much better than student housing. I have 2 college daughters, one in graduate school, one in undergraduate. They both had to come home. They both had off-campus private housing leases. They lost their jobs. They were worried about what do they do with their lease. We looked at the leases and we found in the private student housing that we had Act of God or Act of University clauses that allowed us to terminate our leases in March and not have to pay all the way to August. That is yet to play out in the numbers on student housing. And think of what universities have had to do in terms of rebating student housing costs, meal plans, and other fees back to students. It's a huge budget hit to university budgets, and there was nothing in the CARES bill or Fed intervention programs to help universities. The other one is this urban versus suburban flight. And I think the public builders, I'll go over some of that, they're already telling us their top population group that's coming and looking at and buying homes is at the entry and first move up level from professional urban dwellers, millennials in the dense city areas coming out of the big cities. The number of clients and folks that I have, colleagues in New York, they've already left and they're already in the Carolinas, whether it's Charlotte or Charleston, is absolutely mind-boggling to me. So everything is going to kind of correct, I think, on the urban versus suburban model. This is another neat graphic I found in by my friend Visual Capitalist over the weekend. It looked at what were the fastest growing and declining retail brands before COVID. And so you can see the winners. Lululemon was the top one, 40% growth. You look at the normals you'd expect: Amazon, Costco, Target, Walmart, Sam's, and Alibaba, and Flipkart, which is owned by Walmart. So ask yourself, which of those stay winners and grow at those levels after COVID? The yellow arrows are the ones I think in Amazon, Costco, Target, Walmart, they all do very well. Look at the losers, anything apparel. So if you have any apparel in a retail, it's going to be in terrible situation. Pharmacy, we're seeing that everything is going online. Everything's been accelerated, telemedicine, all of that. So someone like a Walgreens, and the impact for us at CCIMs is, 30% of all commercial real estate is transacted in a 1031 exchange umbrella. And so when you look at less entities like a Walgreens, which was a darling for 1031 exchanges, or branch banks, and fewer of those, we really could see some impact to 1031 exchange market. In the food industry, Subway is now the largest franchise company in the world. It surpassed McDonald's. So who stays? What happens to these restaurant chains? This is the other one that we've shared a little bit. So on the left is our retail evolution paper from last fall in San Diego, when Eddie was installed as our 2020 president. And all you have to do to update this paper is just take everything I forecast happen by 2025 and accelerate it 3 to 4 years to 2021, 2022. Everything in retail e-commerce is just advanced by 3 to 5 years. We had Amazon enter early with Whole Foods on e-commerce grocery. Then we've had Walmart perfected, and we've had every other major grocery chain, Target, Publix, Kroger, King Soopers, you name it, all go there. The graphic in the middle is from Visual Capitalist, showing what we've been spending our money on, and then what we haven't been spending it on down below, things like luggage and swimwear because we couldn't go to the beaches. But off to the right, in the Weight Watchers earnings, they told us some really cool stuff, including in Shopify as well. And they basically pointed out that Weight Watchers went from a model of 75% of their patrons coming in for a face-to-face consultation to just 25% here at 1 month, 2 months into the COVID crisis. So that's a pretty significant change. And I think it's a proxy for what could happen in gyms, things like LA Fitness, or if you have a gym in your inline retail or experiential retail. When my wife now does Zumba, I think the retail gyms are in some serious trouble. So this is some of the stuff to be thinking about as it comes out and what's going to backfill our retail. This is another one on tourism, so hotels. So the Carolinas, you have a lot of tourism, whether it's in Asheville, North Carolina, or Charleston in South Carolina, or Key Island, or any of your great beach areas, or golf, Hilton Head areas. So this shows where are the 20 largest economies in terms of travel and tourism by GDP. And we rank number 9 in the world, number 10. Mexico is the most impacted. And the number on the right here is what just blew my mind away. Worldwide, tourism contributed almost $9 trillion to GDP in 2019. That's over 10% of all global GDP. So when we ask what's the new normal, or what does it look like when we get there, and we don't figure out how to get a vaccine or deal with COVID-19 and travel again, these are very, very staggering type numbers, and they're very staggering for us in the United States. This next slide brings it local. So these are the small and mid-sized metros with the most self-employed workers. And if you look at the list in small and mid-sized cities, so look at some of these names on the left side, they're really small. Santa Fe, New Mexico, St. George, Utah, skiing Hilton Head, Island, South Carolina, got to put a little arrow over there. Grand Junction, Colorado, Napa, California. And then on the right side, the mid-sized metros, you look at a Sarasota, Florida, and Asheville, North Carolina. Go on down the line, Daytona Beach, Ocala, Cape Coral, and Miami's Fort Myers. What do those all have in common? These are all heavy tourism, leisure, and travel areas. They're destinations where people go. And so a lot of the workforce are self-employed. They're entrepreneurial. They're small businesses. And so when you look at where the self-employed, which is just decimated, this thing is really impacted, it's significant. Now, here's the good news for the Carolinas. The fact that you only have Asheville, North Carolina, and Hilton Head on there, what it means is for the Carolinas, you have a much more diversified economy. You're not as dependent on tourism and leisure. What is the big deals for the Carolinas? Well, it's logistics and transportation with your ports and your manufacturing. And that ties into manufacturing. It's also a financial center. Look at all the banks that you have headquartered there in the consolidation of Legacy SunTrust into Truist Bank as part of the BB&T and SunTrust merger. So your financial services, which the Fed's going to see is supported. Logistics and transportation, which is the key to our whole economy going forward and more e-commerce. So while you have some tourism, you have very, very diverse economies, and that doesn't change from what I told you back in February. Office. What happens to office? So Equifax told us in their earnings, they gave us a new line item to look for in the upper left corner there. It's called redundancy costs. So Equifax is going to allow all of its workforce to continue to work remote until maybe the end of the year. So it's got hundreds of thousands of square feet in downtown Atlanta, midtown Atlanta, where it owns and leases office space, and it's all sitting empty. They're not using it. But one of the things they're telling us is that the costs to have alternative workforce solutions, including places where teams that need to actually meet and work on a code project or something for a client or meet with a regulator, doesn't work on Zoom. They need some redundant suburban office space. So they're already talking about that they're going to have to be going to the suburbs and leasing space that's more meeting space oriented in conference rooms and individual offices, and that's going to add to their redundancy costs. This company over abroad called Symbiosi is one that's really developed some cool technology that probably we're all going to be embedding in some way in our office, and not only our office, but probably our industrial, our warehouse, and retail, and multifamily. But it's things that give you apps on your phone, the ability to track density. You don't want to go into the lobby when everybody's there. So it has an app that can tell you how many people are in the lobby, or how many people are waiting on the elevator, or how many people are waiting to get out of the parking garage. It has an app for cleanliness. It tells you when the certain common areas have last been cleaned, so you know it's free and good and safe to enter those. Touch points, it puts everything on your phone so that you don't need to touch an elevator button anymore. You hold your phone up and it'll tell by the app and the QR code what floor to go to. Contact tracing. We're going to give up all of our privacy, whether it's medical or where we go, and they're going to know where we went so they can track the impact, not only for COVID, but next year when we have a flu season outbreak, or we have another virus type thing that breaks out. This is the beginning of all this stuff, and it's going to be very capital intensive on our assets. It's going to hit the expense side, but these are the things that it's going to take to get our psychology back so that we go into more dense areas again, and that we combine and just don't shelter at home on a Zoom screen. Here's another one that came up that I picked up last week, and I encourage you to touch base with our colleagues at IREM about this. They're all over it. But one of the things with all of our buildings sitting empty for 2 months, and maybe 3 or longer months, is that a lot happens in the plumbing. And the water gets stagnant, and you can get mildew buildup, and they're finding already the buildup and outbreak of Legionnaire's disease in empty buildings as they've been locked down and bacteria builds up internally. So as we not only reopen our states and say it's okay to go to church or a restaurant or whatnot, we're going to have to make sure that before we go back into those buildings that we've thought through these types of life safety and health issues. So this is another area, again, where CCIMs are very talented. You've got skill sets in property management. These are where you can connect the dots. This is where you can help clients plan and anticipate and use you and your skill set to help them say, not only is it okay to open up physically, but what do I do to my buildings? What do I need to do to prepare? And it's not just about having face masks and teaching your workforce, but it's physically getting your buildings in shape and their HVAC and their plumbing. So logistics and industrial, I've talked about this. On the left is the paper I wrote almost 2 years ago. Really where I documented that everything we were doing in our economy was migrating from a shop and take home to an order online and deliver economy. And we've just accelerated that by 5 years. And what it means is those that have logistics infrastructure, you will win, you'll be vital, you'll see vibrant economic activity return. In the Carolinas, you have that. You have Class 1 railroads, you have ports, you have vital airports that have the only one in Charlotte with intermodal rail right into it. Forbes did a piece that emphasizes what I'm talking about is going to happen in industrial. So after the financial crisis, we had a thing called CMBS 2.0 to fix all that was broken in terms of CMBS. So we called it CMBS 2.0. I think we're going to have logistics 2.0. And the first example is Port Laredo in February, before the full outbreak, surpassed LA as the busiest container port in North America. I think that we're going to see more north-south trade than west to east, and that a lot of the onshoring of manufacturing from Asia isn't just going to come to the United States, it's going to go into Mexico, because they don't have an EPA that takes 1, 2, 3 years to permit a process. They can do it in months or weeks. This was some stuff I found really fascinating over the weekend on when we look at future technologies and what has to happen in logistics. It was, again, one of my favorite sources, Visual Capitalists. They're great at visualizing data. So at the top, it shows the degree of automation in different things like warehouse automation. We're only at about the 50% mark. Look at autonomous vehicles and trucking. We're very low. Florida became the first state this year to fully implement it. Fulfillment robots, we're only at 10%. With the workforce being afraid and being contaminated, we're going to see fulfillment robotics just skyrocket. And at the bottom, look at that 49% figure. 49% of warehouse and distributor managers say they still use monthly, mostly manual processes for order fulfillment. That's going to have to go to 75 to 80, 90%, probably eventually 100%. So much more technology, much more automation, and CapEx spending is going to go into our warehouse. And the warehouse box is going to become much more CapEx intensive and valuable. This shows the extent of our supply chain automation. So when you look at things like, where we are in terms of automation, look at fulfillment on a scale of 1 to 5, meaning 5, you're fully automated. On fulfillment, the yellow arrow on the left, we're only at about a 1.25 scale out of 5 that we're automated. And then look at returns management. It's like a half of a 1. We have a long ways to go. And what are the top barriers to this? One is budget approval, and the other is its software. And then the third was really vendor issues. It's not just you, but it's your partners as well. So these are some of the obstacles that we're going to have to figure out to go to Logistics 2.0. Couple last things here. So when we finally get there to the other side of COVID, what will be there is the question. So I found this great graphic over, again, Visual Capitalists, and it shows a year ago, this little obscure company called Zoom that not many of us knew or were just experimenting with. It now has a market capitalization greater than our 7 largest airlines in the world. That's mind-boggling to think how in really 90 to 120 days, a technology company can so revolutionize workforce and be worth more than all of our aviation industry. The other one in the middle is a great graphic. Barry Wolf posted this on LinkedIn, and it shows fast food restaurants by value and by revenue. And a couple of things I want to point out here is what is going to happen to the CRE in things like airports, when half of our airports maybe don't have the same service, or hotels, or experiential retail, or restaurants. So Chick-fil-A, as many of you know, I follow a lot and do stuff with. Before COVID, for the last 2 years, they've been redoing all of their stores. They've been tearing them down, moving the restaurant from the center of the site to the back of the site to allow for more drive-through. They developed a great app rather than a self-service kiosk like McDonald's. And they already were ready to handle 3, 4, 5 times the amount of drive-through traffic in their restaurants than anybody else. And then comes COVID. And the Chick-fil-A restaurants that opened with this new model in the drive-through, their sales never went down. They stayed up or actually increased 5 to 10%. So think about what is an old Taco Bell or McDonald's or an Arby's worth that only has a single lane drive-through that can only do 10% of the total revenue in drive-through. Is it a teardown that has to be really completely rethought through like what Chick-fil-A has done? And what's the value of that real estate? What's the adaptive reuse? Is it just an out parcel that needs to be scraped? These are kind of things, when we get there, what's going to be there? So ultimately how I think we get there, it's one part we've got to get a lot more testing. One part we absolutely have to have a vaccine. It's one part, a lot of technology is going to go into our commercial real estate, and that technology is going to make that real estate worth more efficient, more productive, and more valuable. And we've got to be able to distinguish it from pre-COVID real estate. And one part, immunity passports. We're already using these in Europe, and this is how we get there. So I'm a diabetic. I do blood sugar testing every day, have my glucose monitor, takes my reading, whether it's on my arm or in my manual thing. We are going to have testing in a year and a half where we have stuff that we buy at the drugstore. And when we want to travel or go to the city or go to a concert or a football game, we will take a swab in our nose or our mouth. We'll put it in this device. It'll check for our antibodies. It'll check to see if we have the new virus or the new flu strain of the year. If we test negative, it'll upload to an app, just like our Clear system at the airport, and you'll be safe to travel, go to work, go to a concert, or go to an SEC football game. You think I'm crazy? It's already being implemented right now and used in Europe, Italy, Spain, Germany. And we have the technology. The Clear system at our airports was a medical records technology. They already have the ability to vacuum up every medical record on us, including our flu shots. And we're going to tie that with occupancy monitoring and the type of tech that I gave you before. And just like it was as foreign to us before 9/11 to have a TSA and a pre-check and taking our shoes off at the airport and surrendering the privacy we did to go through TSA pre-check and Clear, we're going to do it on medical to get to the other side of this COVID. So we are at the end. I'll be able to take some Q&A. I have a new Winston Churchill quote for you. So this is my new one that I loved, where Winston Churchill later in his career said, "I no longer listen to what people say," because he largely found they didn't tell him the truth. He said, "I just watch what they do. Behavior never lies." That's what earnings, what companies are doing versus the forward guidance they used to give us is what tells us where we're going to go. Tune in on Thursday for the CCIM webinar on Q1 earnings. This is where we're going to tell you what's happening on behavior and why it never lies. And I'm a car guy, so this is how we will be doing Woodstock reunion after COVID. We'll have our 67 VW buses. We'll be 6 feet apart, have our camper tops, and we'll be enjoying life again. So with that, I will stop and return it back to you and see if we have any questions.
Terrific, KC. What a great presentation. Several of the questions that came up in the chat box during your presentation, you actually addressed in part or in some cases in total through your later comments, but a couple that stood out to me. You talked about some of the various sectors involved. Which of these do you think look good? You talked about some of the sectors that could be problematic, which could be good possibly in the months ahead. And unrelated, but a separate question that I thought was interesting is how is the infrastructure spending that could occur from the government, how's that going to factor into any upcoming spending bills?
Yeah, really good stuff. Let me start with the infrastructure, because a lot of the infrastructure is really, as you know, funded at the state and local level. And these governments are under huge deficits. So in Georgia, we have a $9 billion deficit hole right now where the legislature is going to have to go back into session. We only let them meet for about 90 days a year so they can only get a budget done and not screw with our lives very much. They do the same in other states like Alabama. So these states are automatically cutting a lot of the infrastructure spend, which is kind of crazy because if you think about road projects, they're never going to get asphalt this cheap. They're never going to get labor this cheap. But when they look at, well, what do we do with police and fire? And if there's not a federal intervention to fund the police and fire over time and first responders, then I got to redirect budget there and not do infrastructure projects. So I really am worried about infrastructure projects, more of it that's funded at the state and local level rather than the federal government. If the federal government in this next fiscal bill doesn't address some of those needs, then I think we really have a hit on infrastructure spending. The good news for the Carolinas, you look at your ports, it's a state port authority. They've already done their budgeting. They've already got their funds put together. So things like dredging and the Corps of Engineers, those funds are already allocated and put away. So I don't think there's any risk for your port. I worry about the airports because I think one of the things we're going to find is that I'll talk about in the earnings with Eddie is the airlines are largely not going to go for the government bailout program. So they have to kind of go right now through September. After September, they have to decide to opt in and give the government a part of their business. Lufthansa just did this with Germany, and they had to surrender 20% of the airline to the German government, including board seats and veto powers on things that they do. I don't think our U.S. airlines are going to do it. They've already told us this in earnings. And they're going to probably opt bankruptcy, which means they can discharge a lot of contracts. Contracts like new plane orders, that's important for Boeing in South Carolina. They can discharge gate contracts. So for your airports where you don't have the demand, like in Atlanta, we may see whole terminals empty and they renegotiate those. What could it mean for Charlotte? It could be an opportunity for Charlotte, because if Delta is only going to need half the capacity and it wants half the harassment from, say, the Atlanta airport and the city of Atlanta and its challenges, it may look around for a new spot. And Charlotte could be a unique place to compete, something you have your leaders looking at. Where might we put a new airport with our facilities? As you know, I voted North Carolina the state with the best airports a year ago. I mean, your Raleigh airport, your Charlotte airport, I mean, your airports, what you've done in Greenville, are absolutely phenomenal. But I do worry for your secondary markets, a market like Charleston or Columbia or Greenville. These markets, you might find that the airlines, they can also discharge route structures in the fall. And we've already heard airlines are already starting to do this. They're already getting permission, but in bankruptcy, they'll be able to do it. So if you have less air travel, so think about Greenville and BMW and what a great international city it's become for manufacturing. If now the Germans can only get in there once or twice a week in direct flights instead of daily, what does that do in terms of future economic development and activity? It's going to be a big thinker. So the infrastructure was one, and then what was it? The other part was where are the opportunities, or where do I see the risks by property?
Correct. So by industry sector, where do you see that there are some good opportunities beyond the ones that you felt were challenged?
Yeah. So we're going to create a new NAICS code called adaptive reuse. And we've written a book on it, right, from the CCIM Institute. So think about all things. I think telemedicine. So telemedicine is a tremendous opportunity to repurpose a lot of retail. We're going to find that a branch bank may be a great place for telemedicine and testing. We got the drive-through. We can put our test kit into the tube and shoot it on into the lab, and they can do the test, and we can come back an hour later with our results and never have to get out of the car. So I think telemedicine and how we disperse medical care and treatment is going to be a huge opportunity. I mentioned supply stock and demand stock. Where are we going to put this extra inventory? We don't want it clogging up our big 500,000 and million square foot e-commerce warehouses. We want it out of sight, out of mind, so when we need it, we can go get it. So that could be, again, that repurposing of retail, department stores, closed big boxes, or it could be old industrial warehouse in a secondary city. Secondary locations could become great situations where they have good interstate, maybe good rail connectivity. So think about your class 1 railroads that come up, Norfolk Southern and CSX through the Carolinas, and that you could move stuff in and out of the airport for supply stock. So you could fly in some PP&E when it gets down low, and then you could move it out into a secondary location by rail or truck. So I think, what do we do with supply stock? It's going to be a whole new industry, and it's not going to be where our big warehouses are. It's going to be where it's cheap. It's a new cost, so we're going to repurpose cheap buildings. So we can buy them at 25 to 50 bucks a square foot instead of building them at 200 bucks a square foot. That's going to be a good bet. I think trying to figure out what we do with hotels. Do a lot of these hotels become affordable housing opportunities, senior citizens, senior housing? I think another risk opportunity is, what do we do with senior housing? Senior housing, assisted living, the senior people. I have more colleagues and friends whose parents, their grandparents that were in senior housing or assisted living have said, get me the hell out of here. I'm never going to be locked up away from my family again. And so that's going to be another one of those areas we're going to have to figure out. And then I think on the housing, what do we do with student housing in college towns? We're talking 136 that play NCAA football. We're looking at over 200 college towns in this country. They're going to have massive destruction in terms of retail, commercial, small business, and whatnot. So those are, they could have golf courses. What do we do with golf courses? Those could be new affordable housing subdivisions. We don't need all those anymore, Kelly. We're going to take care of Hilton Head. We're going to put affordable housing on Hilton Head golf courses. Does that work for you?
All bigger distance apart there.
Safely apart.
Plenty of distance.
At least a club length, right?
Right. Six feet at its finest. Let's see, to elaborate on another question here, and also the topic you were just mentioning there, I know you said fall of 2020 is when you see the low. Do you see that as being probably the worst point of what could be the potential commercial loan crisis and bankruptcy crisis? And then when do you see the second part of the W? At what point would that be? Spring of 2021 when you really see us starting to recover?
Yeah, so a couple of things. So the Fed's just going to keep shoveling money, right? We went from less than 4 trillion to 7 trillion. Chairman Powell's already said he's taking it to 12 trillion by the end of the year, and he has no problems taking it to 20 trillion. Now think of that. That's almost a full year of GDP. So what that means is the Fed's going to do everything to keep the banks liquid. So financial services is a big part of your world in the Carolinas, in Charlotte. They're going to keep the banks alive and liquid. They're just not going to make a whole lot of money. At 0% interest rates, there's no net interest margin on those the deposits versus what they lend out at. So, but they're going to keep the banks liquid. They're going to keep the credit problems from going. They'll encourage them to sell debt rather than to foreclose and work it out. So I think that's going to keep playing out through the fall. And I really think the dark days could be, December to February, March of next year. And here's why. One metric that I'm looking at that tells, well, there'll be two. So one, I'm looking at the TSA air traffic control passenger count. So if we don't get that back to 1.5 million by the end of the year and the holidays, we're in a lot of trouble. I mean, we're looking at huge parts of our economy systemically damaged, really almost forever, and systemically. Number two that I'm looking at is I'm looking at what happens to this 8% of all mortgages that are in forbearance, and look at the delinquency rates already. When the homeowners come off these forbearance programs, then what? So if you're a young buyer or a family that took out a 90% LTV loan and you defer your mortgage for 1 year, you're over 100% LTV when you come out of that a year later. And so what is the homeowner going to do when they know they're over 100% LTV next spring? And maybe we still have unemployment that's 10%. I don't think we're going from 22% back to 5% real quickly. I think this is 2 years or more to get back anywhere close to 5% that we will see, whether it's hospitality, retail, small businesses. When 1 in 4 small businesses are gone, and that's 60% of the economy. When 40% of all restaurants are gone, when all of those things are gone and we tally them up at the state level data, we don't understand those numbers. We don't see those numbers until really the fourth quarter of next year or the first quarter of next year. So I think the dark days really come the holidays, which is going to really suppress holiday purchases and sales. And then I think the spring, figuring out what happens to all these homeowners that were on forbearance programs and didn't really understand how much that tally was at the end. And I think then it's going to be up to the Fed, which owns Freddie and Fannie. They have them in conservatorship. What do? Do they just intervene and say, we forgive it? And they haven't given real good guidance. And I don't know if you saw over the weekend, but Freddie and Fannie announced they want to accelerate in this next legislation with Congress, getting them out of conservatorship and returning them to the market while they're still a market. Well, while that makes sense in one respect, this may be the one time where we want to keep Freddie and Fannie in a government conservatorship where the Fed can do anything they want. A while back, I shared a graph I took out of this one, but who holds debt by property type and by lender type? And of all property types are pretty stratified, which is good news compared to 2009. But in housing, single family and multifamily, 93% of all mortgages, multifamily and single family, are held by Freddie and Fannie and the government-sponsored enterprises. So we remove them out of the government into the free market. We could see real disrupt. This is not the time we experiment with that type of program, but they've already said it in their earnings on April 27th. They're going to go ahead and accelerate. So that's where I worry. I really worry. It's the end of this year. We're going to see good progress, good lift. The other thing that I worry about, look at what the colleges like Notre Dame and others are already telling us. They're going to start bringing the kids back earlier, like the end of July, first week of August. And they're going to conclude exams by Thanksgiving. So when they go home for Thanksgiving and we start the new flu outbreak and COVID outbreak too, they don't come back. They haven't been contaminated with mom and dad and they come back to college. So we're going to see behavior mechanisms. And I will tell you, being a parent, and my wife's had to do a lot of the heavy lifting with my 9-year-old special needs son, that parents that are doing the homeschooling and the remote learning, we need a paycheck for being teachers. It's unbelievable. There's no way you can do work. Both of us are working, 16, 18 hours a day to do the remote work and everybody at home and get our real work done. So we got to get kids back to school. We got to figure out how to make this work. And I think that's, again, why I think the fall is going to be a particular strain. Parents are going to be ready to basically pull their hair out or run away to another place in the world and leave the kids behind if we don't get schools open.
KC, I'd love to know what thoughts you might have on the potential relocation of the Republican National Convention from North Carolina to another state. Do you think there could be any lasting impact, or is it all political?
I'm stale. Is that really a legitimate concern they're throwing around?
Yeah, I was all over Twitter yesterday, and of course, Governor Cooper's now on the defensive. But if you're not prepared for that question, we've certainly got some others. I know it's a big disappointment for us in Charlotte, particularly having had the mid-year governance meetings postponed or canceled for this year.
So I'll give you a few thoughts on that. Wish we could put the election off a year, but we can't do that from a constitution. So you think about a lot of things that have been deferred. We will have football, NASCAR's up and running. The Olympics got deferred a year. You know, in Alabama, we were supposed to host the World Games 2021 next year. We pushed it off a year. So my message to Charlotte was, Charlotte, well, that's a blow, and you lost the opportunity cost to maybe book some other things. You would have lost those anyway. I don't think that convention business is coming back as quickly over the summer. So the hospitality and convention business and those bonds are really probably going to be adversely impacted. But I'm betting that Charlotte is one of those cities that recovers really well. Let me give you a couple examples. I'll compare it to Atlanta. So Atlanta is not a very walkable, friendly downtown area compared to a Charlotte. It feels more open. It doesn't feel like a big congested New York City or Boston or Philadelphia. So you don't have that sense of I'm all crammed in. You have a great convention center. You have great public transit. You can walk or take the rail. So I think in terms of convention cities, people are going to be a little bit leery of the Orlandos and all the theme park temptations and not wanting to do that. They're going to be leery of something like an Atlanta, a New York, a Las Vegas. But when you look at markets like maybe a Nashville, you look at a Charlotte, I think these are the winners. These are the beneficiaries when we reestablish. But we're all going to take a hit, I think, here this summer. I will tell you anecdotally, my best indicator that things could come back, but they be in smaller hotels have got to be nimble. I already have 9 requests with guaranteed checks to have me go ahead and book to start speaking the end of August into early November. So these are, you know, groups like NAOP and ULI and CCIM that are saying, we're confident, we'll guarantee and we'll send you your check now, be there. And they're all cities that I can drive to. So I think the other thing you're going to see is cities that are drivable versus flyable, which a Charlotte is. You know, remember that was one of your big pitches for logistics and trucking. You can draw a lot of people from a lot of population centers. I think Charlotte's going to be a big beneficiary of that. So I wouldn't sell Charlotte. We're all basically bleeped here this summer, but I think things are kind of come back in the fall. And I think that next year we'll see companies begin to hold meetings and events and stuff. But those cities that are more drivable, that don't feel congested, are going to be winners. And I think a Nashville, a Charlotte are definitely in that category. Charleston, definitely. You can walk anywhere you want.
We had a lot of out-of-state cars in Charleston over the weekend. I will say that. I think a good many of them, I want to say, probably didn't go back at all. Might be here for good.
I think you're right.
So I know you have to jump off in a few minutes. One question that I saw on here a couple of times might sum up some other things are, what are some of the big changes that you've seen based on where you thought the economy was heading back in April to what you're a little more fearful of, or where you think we should focus our attention now that we're almost to the end of May?
So good question. So I'll tell you, Kelly and Charlie and Eddie, I'm going to start a new economics club. It's going to be called The Most Inaccurate Economists. And so I don't think any of us got our numbers right in January. And if any of us did, we need to be investigated for links to China and Wuhan, that we knew something. The thing that surprised me the most, to be honest with you, has been, number one, the rise in mortgage delinquencies and the degree which loan forbearance has had to be required to keep housing healthy, and that we have no clarification at what happens at the end. The Freddie and Fannie have not really given clear guidance to property owners that got loan forbearance, as long as they didn't, they provided forbearance to the tenants. And we really have no clear guidance on how that's going to play out. Freddie and Fannie expect to issue that, and they expect to say, you can't get it all at once. You need to look at like a loan or a rent renewal, a lease renewal over a year, and you amortize it. You can't report it to their credit agencies. So one of the things that scares the dickens out of me is when I read the Equifax earnings, and Equifax was so boastful about how much revenue they had made on credit inquiries for anybody requesting a rent forbearance or a mortgage forbearance. It was 43% of their revenue. Mind-boggling how Equifax and the banks are doing all kinds of mass credit reporting, and we don't know what they're going to do to our credit scores. So that's one that really worries me, is the impact to the consumer on credit scores, on all the, and just accessing intervention programs like loan forbearance. The other one that surprised me is I had a number of very large multifamily investors, I mean, that own tens of thousands of units. And they shared with me recently that a third of their tenants paid their rent on credit card in April instead of doing a rent forbearance, because they didn't understand it, they were afraid of it. And so, think of this, they just ruined their credit score. They're putting their rent and running up their balances on their credit card at 15+% interest rates, when the loan forbearance and the rent forbearance, that Freddie and Fannie are going to say it has to be at no interest rate charge, because they're not going to charge the borrowers interest on the amount that they had for forbearance. So I think the housing piece is what's really surprised me. We knew it was going to be awful in retail. We knew it was going to be awful in hotel. So those are big ones. The other one is, I think, on logistics, how really screwed up our supply chain is. We were not ready for this. We were lucky we were able to hobble together and get groceries and toilet paper flowing. But for the rest of the supply chain, it really is very manual. It's not well connected and it's not automated. So the effort on logistics 2.0 is going to be massive. It's not going to be a very moderate thing. And then layering in things like supply chain. So we knew retail and hotel were going to be awful. That didn't surprise me. I think the other one is on the jobs numbers. So I think I was fully prepared for 10 to 15% unemployment, but 22.4%, the U6 real unemployment rate, and we're not done yet, and 40 million jobless claims. These are mind-boggling numbers. Those are what surprised me. What I'd say that makes me feel reassured from what I told you guys back at the beginning of the year, the fundamentals and foundations of the North Carolina and South Carolina economies, very diverse, invested in infrastructure, great airports, great ports, great rail. None of that is changed. Those will be the things that you can lean on to come back and to have what industry does survive and what does come back. I think you'll be stronger than many other markets, and I wouldn't back off that at all.
Very good. Well, Eddie Blanton, our CCIM Global Institute president, is here with us, and I think we're going to give him the opportunity for the last word. Eddie?
Hey, thank you, Charlie. I appreciate you and Kelly and all the work that the North Carolina and South Carolina CCIM chapters have put into this event. KC, thank you as always, and I look forward to hosting you on Thursday for our Institute event. And just want to say a couple quick things. Number one, it's a pleasure and definitely a privilege to be able to represent each and every one of you from the Carolinas and all the other CCIMs globally as the 2020 president. You never know what's going to hit you in the face as president of our institute, but I learned it real quick what hit me in the face for this year. So it got us all, I know. But it is truly an honor. You must lead in good times, bad times, and uncertain times. And that's where we are today. I'll leave everybody with one thing, and that is, please stay healthy, stay safe, and stay positive, because that's what's going to get us through this. This is definitely unlike a 9/11 or even the recession that we went through in the late 2000s there. And everything's different. We're in an ever-changing industry. And so always look at it with this. Yesterday was different than today. Tomorrow is going to be different than today. And that's how our business is. It's always been that way, and it's always going to be that way. So just do what you do best, use your skills, use your resources, and prove why you are out there and doing what you do each and every day, and also why our clients and customers need us each and every day as well. So thank you once again. It's an honor to serve. Like I said, I'm glad to be from the Carolinas. I originally was a South Carolina chapter member back in the late 1990s before I moved to North Carolina. So I've seen Charleston and Charlotte. And our next president is Tim Blair out of Alabama, and then Les Callahan from Atlanta, Georgia follows Tim. So our region is very strong: North Carolina, South Carolina, Georgia, and Alabama. And I'm also happy to report, for those of you that don't know, I was able to appoint Steve Rich as our 2021 Institute Treasurer. So we're going to continue that moving along. So you talk to Steve, you see Steve, congratulate him, because I'm really looking forward. He's our 2020 Treasurer-elect. He's jumped right in. He's doing a fantastic job, and he's going to make sure that we're financially strong in 2021 and beyond. And just know that the Institute's there for you. Thank you very much. Again, Charlie, Kelly, back to you.
Thank you very much, Eddie. We appreciate you being on the call today. And I'd like to take just a moment to say thanks to our chapter coordinators, Jordan Mancini in South Carolina and Paige Stroud in North Carolina, for helping today. I think logistically this came off well. We would love your feedback and input on similar formats and presentations we might have in the future. And certainly thank you to Kelly, our South Carolina president. And Kelly, if you'd like to send us home, please.
Thank you. Just want to thank you everyone for joining us today, and big thank you to KC and Eddie for joining us as well. This was very and really great words to help us all figure out how to think forward in these changing times and get creative and stay on top of the market. So it's going to be changing but exciting times ahead.
Exactly. KC, thanks again for being with us today. Everyone be safe. We'll be in touch soon. Take care.
Thank you.
Bye.
Bye-bye.